Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil jumps as Israel strikes what it calls military targets in Iran after intercepting missiles from the Islamic Republic. That is despite President Trump urging Israel's not to retaliate. Asian stocks slump as the AI-led rally unwinds and stronger than expected U.S. jobs data reinforces bets for Fed rate hikes. Plus, we discuss the energy crisis with Karen Young from Columbia University and Dubai's property market with OMNIYAT chair Mahdi Amjad later this hour. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Let's take a quick look at markets this morning. A rebound for S&P futures. This is after a slump of 2.6% in Friday's session. Nasdaq slumped 4.8%. That is the deepest move downward since April 2025. And this is really bringing questions about the AI rally. Has it gone too far, too fast? We'll answer some of those questions later. But the contagion is perhaps catching up to Asian equities this morning. Look at that move, almost 3% lower. Japan is dropping. The Kospi in South Korea is dropping. We've got Winnie to talk to us a little bit more in details later in a couple of minutes. And then we've got Brent crude. It is rising this morning, 3.5%. Higher now, fresh round of attacks this morning. Israel hitting Iran. Cities in western Tehran, including Isfahan, including Karaj, are being hit this morning by ballistic missiles. This is after hostilities that we saw yesterday between Hezbollah and Israel as well. The yield on the 10-year notes is not doing so much today. It is gaining 4 basis points, but this follows a robust jobs report in the U.S. on Friday, bringing those prospects of a Fed rate hike yet again to the picture. But returning to the AI story, I want to flip the board and take a look at the terminal chart that we have this morning. And it's really about this rotation. So what we're seeing in this chart, look at that bar, look at the last bar. What we're seeing, and this is pointed out by our markets team, our colleague Anthony Stevens, points out that we've seen the biggest rotation on record between U.S. semiconductors and low volatility stocks. And again, I point to the last bar in this chart. That is the biggest rotation on record, and the latter, which is low volatility equities, that includes Berkshire Hathaway and the kind of names that Buffett used to own. But I want to know more about what is happening in Asia and the deeper picture there. Let's check on how markets there are faring. We've got Winnie Su in our Hong Kong studio. Winnie?
Good morning, Abir. A pretty bad Monday for Asian stocks. As you can see on the board, that most Asian equities are in fact in the red today, with the MSCI Asia here down almost 3%, as you mentioned, and it's the biggest intraday loss since March. Now, there are a lot of headwinds, including the expectation for the Fed to raise rates and also geopolitical tensions forcing the oil prices to actually jump as well. Now, you have the tech-heavy gauges in Japan and also in Taiwan, both down more than 3%. But more than anything, South Korea's Kospi index still leading losses, down at one point as much as 8% and triggering a trading halt. Now you flip the board and take a look at where that gauge is trading right now, just down about 5%, nearly 5%. So you can see that pairing a bit of earlier losses, as well as we actually saw SK Hynix at one point also flipped into the green. So you can see that still lots of interest when it comes to dip buying, with President Lee actually saying that South Korea's market is quite undervalued in his earlier comments earlier today. Now, when you look at the South Korean won, interestingly outperforming Asian peers today after authorities unveiled some new measures to stem the weakness of the won, and also President Lee saying that the weakness in the Korean won is actually temporary. Back to you, Abir.
Winnie Su in Hong Kong with those details for us. Now let's turn back to the regional story. Oil is edging higher today as the IDF says it has struck what it calls military targets in Iran. This is after the Islamic Republic earlier launched missiles towards Israel. Iranian media are reporting explosions heard in Tehran and other cities. And President Trump had urged Israeli Prime Minister Benjamin Netanyahu not to retaliate against the Iranian attacks several hours ago in a phone call. For more, Bloomberg's Dan Williams and Onur And, our managing editor for the Middle East and North Africa, join us now. Dan, I want to start with you and what you're seeing happening in Israel. I mean, the attacks this morning also follow some hostilities we saw yesterday between Hezbollah and Israel. What can you tell us about what's happening where you are?
Indeed, Abir, and what you're noting here is the very peculiar and very awkward and very dangerous trigonometry of this conflict. It's not just Israel and Iran. It's not just Iran and the United States. It also involves Lebanon. And as I'm speaking, there is an explosion overhead, apparently an interception of another missile that came over. So if you heard the explosion, I hope that serves as an explanation. And now the sirens are sounding. So forgive me, I'm going to have to cut this short and take shelter. Have a good day, everyone. Bye-bye.
Dan, stay safe where you are. That was Dan Williams. Now, turning to the region and what we know about the broader deal, Onur, I want to turn to you now. You heard what is happening in real life with Dan, but essentially when it comes to these fires being, these fires happening between Israel, Iran, and what we're seeing in the wider region, where does that really leave the wider truce agreement? I mean, we're seeing this happening again, these hostilities coming back to what, while President Trump is saying a ceasefire is still in the works.
Well, the truce has always been very fragile, and I don't know if we can still call it truce, but what's happening now shows that fighting can spiral out of control very easily and very quickly. There are two main challenges facing President Trump and the truce in general. One is the fact that this was agreed to between Iran and the U.S., and Iran has repeatedly made it clear that it does not see, it just sees one truce, one ceasefire as one uniform cessation of hostilities across the whole region. It does not want to allow its groups, the groups that it supports, such as Hezbollah, to be treated as part of a different conflict or as part of a different diplomatic track. That's where the current flare-up is coming from. And second one, again, the truce was agreed to between the U.S. and Israel and Iran. Israel was not a party to it, and despite what Trump has repeatedly said about who calls the shots, it's clear that the government in Israel sees the fighting with Hezbollah as its own national security issue, and it does not see itself as bound by whatever that the U.S. and Iran are negotiating over, and that seems to be underpinning the latest flare-up in the conflict, which, again, as I said, risks spilling out of control quite quickly and unexpectedly. That's what's been evident in the fighting overnight.
Onur, thank you for that update. Onur And, our managing editor for MENA this morning. Now, Asian equities are on course for their sharpest intraday drop since March. And this comes as a sell-off in tech shares gathers pace and tensions flare between Israel and Iran. Joining us now is Manpreet Gill, CIO for Africa, the Middle East, and Europe at Standard Chartered. Manpreet, I want to discuss the geopolitical story and the tensions that we're seeing there. But perhaps first we talk about the AI trade. Now, your bubble meter, you've upgraded or updated the note in that from better to good. The question to you here really is, after what we've seen in the U.S. on Friday and the contagion in Asia this morning, what are we thinking about the AI trade? What are we thinking about the valuations?
So I think the story at the moment in AI is one about positioning, investor positioning, and just how much optimism is baked into that. And I'd really separate that from the fundamentals, because the earnings to me are a very separate story where there is still quite a bit of support from the fundamental side. But whether you look at semiconductors, which is where the current rally has been focused, including what we're seeing in Korean and Taiwan equities, or in the US, or the broader AI sector, I think what we've seen investor positioning flip from quite sort of bearish and, going back to February, March, to quite a lot of optimism baked in. And the thing is, that's not a reflection of fundamentals, but we've seen historically this sort of positioning does tend to trigger, temporary corrections, and that's really what we're expecting.
So, the broader picture, when it comes to what the Fed or what central bank policy looks like now, we've seen a robust jobs report on Friday from the U.S. Now, President Trump did tell NBC News that he doesn't think that rates should be hiked. But with Kevin Warsh's job cut out for him, do you see that, this economic data out of the U.S. fueling the argument for a hawkish stance?
It certainly would fuel it. I think when comparisons are made to 2022, one of the strongest cases for not raising rates this time is that while we have those higher oil prices, we do not have, unlike 22, a strong labor market that also risks fueling wages. Now, when we're starting to get a little bit of strength in the labor market, that's of course good from a growth perspective, but it does make the Fed's life a little bit more complicated because rather than just worrying about oil prices and the fact that inflation so far we've not been seeing significant second round effects, now it means that we most probably pay a bit of attention to it. I think as a baseline, we still think it seems reasonable for the Fed to stay on hold, even if the tonality becomes more hawkish. But undoubtedly, the labor market is an important ingredient in that mix. So we're most probably back in a world of good news as bad news, at least for the short term.
So you spoke about inflation a little bit, and we've been hearing this over the past 4 months or so, that the impact of what is happening in the region is not yet having a marked sort of consequence on global inflation. What we're seeing again is Iran just now launching missiles towards southern and central Israel. This is state media reporting. So we're seeing these tensions flare up. When do we get to a point in this conflict where we can say this is the impact on inflation, this is the disruption, this is what it is creating, and this is what changes the risk sentiment?
So the most important number to gauge that, in our mind, is the U.S. five-year inflation expectations, right? Because at the end of the day, we know that higher oil prices, mathematically translate into a higher inflation number. But at the end of the day, if that's a one-off rise in headline inflation, we don't see the impact on core inflation, we don't see the impact in inflation expectations, then it's quite possible for the rest of financial markets to not worry. And I think that's been the world we've been in for the last couple of months. And look, the good news here is that those market inflation expectations, they're still relatively well capped when you look beyond 1 year and we look at long-term inflation expectations. That's also important for the Fed, and I think why they've also been able to stay quite balanced. And look, if I look at oil prices this morning, despite the escalation, we're still looking at Brent below $100. So there is some room for optimism, but no doubt this escalation, the job market data, is all coming together at a time when there was so much optimism baked in. We just think in the short term, markets have room to take a bit of a breather. In our mind, that doesn't change the long-term view. We think those earnings are still there, but I think we've had quite a strong rally in the last few months and room to perhaps pull back a little bit.
And look, just briefly on hedges, and you mentioned in your notes that this is one question that your clients are asking, is about gold overtaking U.S. government bonds as the world's largest reserve asset. So what does that tell you, and where does gold end the year?
So gold, I think, we see it as part of the trend that really started in 2022, which is central banks looking to diversify, in addition, and trying to move away from just that big concentration in gold. And arguably, that's coming more from emerging market central banks. They're not completely price insensitive, so we have seen in the past that when you get these strong rallies, sometimes you DC buying sort of slow down. But the World Gold Council data shows us that, on average, central banks are still buying at a strong pace. And we can debate the levels. Obviously, far more short-term capital is now involved, but we think that long-term trend is in place. For us, it fits in the broader theme of broadening, right? There's a semiconductor rally, whether it's within equities or beyond equities. We think that now is a great time to broaden one's exposure. And gold, of course, being part of it alongside with non-AI sectors.
All right. Well, Manpreet, thank you so much for those insights. Manpreet Gill, CIO for Africa, the Middle East, and Europe at Standard Chartered. Now, NVIDIA and SK Hynix have agreed to collaborate on designing future generations of memory chips for AI. The announcement came as NVIDIA CEO Jensen Huang visits Seoul for meetings with his company's Korean partners. The deal gives SK Hynix a boost as it prepares to expand into the next generation of high-bandwidth memory, known as HBM4.
We will expand our partnership from AI supercomputers to CPUs to PCs and, of course, very exciting robotics. These are the elements of our partnership. We're very, very grateful for our friendship with SK Hynix. Our partnership is world-class, and today we're announcing a major new enhancement to our partnership for the coming years.
Now, coming up, OPEC Plus agrees to another output hike despite the Strait of Hormuz disruption. Details on that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. OPEC Plus has agreed another increase in oil output quotas for July, even as the Strait of Hormuz disruption prevents producers from bringing additional barrels to the market. The move is largely symbolic for now, but could become significant when exports from the Gulf resume. For more, we're now joined by Anthony De Paula, Bloomberg's Middle East energy markets reporter. Anthony, the meeting happened yesterday. What message is the alliance really trying to send when so much of the supply is still stranded in the Strait?
Exactly. Good morning, Abir. OPEC Plus just keeps getting ready for that ever-elusive reopening of Hormuz. And the signal that they're sending is that they're not going to restrict production when that happens. So they're telling the countries to go ahead and increase production if they've got the possibility, increasing those quotas and rolling back some of those cuts that they'd put in to support the market in the past couple years. Now, it's largely symbolic, as you say, because the main amount of spare capacity, the oil that these producers can still bring online, is in the Gulf. So the main bulk of spare capacity is with Saudi Arabia. Previously, we had a lot in the United Arab Emirates, but the UAE left OPEC Plus as of May 1st, so they're out of the group. There's also Iraq that could add, Kuwait, but these countries have had to scale back production because Hormuz is shut, because that oil is blocked in the Gulf. And so it depends on how quickly those countries can get their production back in operation and back to the market. And one of the issues that OPEC Plus was having even before this crisis, the war in the Middle East, was that not all the countries were able to produce up to their quota. So that was an issue that was holding back some of the production levels and their ability to react.
So what does this whole thing mean for the outlook on oil prices? We're still below $100 despite the geopolitical headlines that we're seeing, about $95 for Brent. What does that mean for the coming medium term for oil prices?
Yeah, a lot of people would have seen oil prices much higher with a closure of Hormuz. We had a story over the weekend about why prices haven't reached those levels, the 200 that some people feared, and that's because first of all, we've seen a lot of jawboning from the Trump administration talking constantly about how we're close to a deal. The market is starting to discount that a little bit as we go further, but we did see prices this morning reacting to those renewed strikes, missile attacks by Iran on Israel, and the risk of an Israeli retaliation and potentially hitting any kind of those production assets that we need to come back. Plus, we've seen lesser demand in China as they use their stockpiles, and we are still seeing some oil sneaking out of the Gulf, kind of turning off their satellite transponders and getting out without us seeing it. So those factors are keeping oil low, but we will continue to see it bounce around because of these geopolitical issues.
So oil sneaking out. Anthony, thank you for that. That was Anthony De Paula, Bloomberg's Middle East energy markets reporter. Now, coming up, Etihad Airways says it's recovered from regional disruptions faster than expected. Our interview with the CEO is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. Now, Etihad Airways has recovered faster than expected from regional disruptions due to the Iran war. CEO Antonoaldo Neves told Bloomberg that he expects capacity to reach 110% of last year's levels by mid-June. So we'll get back to that tape at a later stage, but for now, let's move on to some other stories. Chinese President Xi Jinping is heading to North Korea today for his first trip there in 7 years. Analysts say he wants to reassert Beijing's influence over Kim Jong-un as the North Korean leader rapidly expands his nuclear arsenal and deepens his alliance with Russia. The two-day visit comes just weeks after Xi hosted President Trump and Russia's Vladimir Putin in Beijing. And now let's get back to the package. Etihad Airways has recovered faster than expected from regional disruptions due to the Iran war. The CEO tells Bloomberg that he expects capacity to reach 110% of last year's levels by mid-June. Take a listen.
We're back on track. That's what I can say, right? Of course, we had a transition period. First week of March was more complicated, right? We have to ground the airline for 2-3 days. We started to come back slowly, 20% capacity, 30% capacity. We did about 50 to 60% in April. So May we did about 70% of ASKs. I'm talking ASKs. Right now we're about 85, 90% ASKs right now. Yep. And June 15, when the summer season starts, we go actually to about 110% of last year capacity.
Right. Are you surprised by that?
I'm a bit surprised, right? Because I think the speed of recovery is really going well for us.
Yep.
And it's different for different airlines in the region. So I'm more surprised about the fact that some airlines are performing differently in terms of recovery than the fact, but I learned that was expected, right? Because the constraints different airlines have are different in terms of airspace availability, right? So in our case, we have a lot of airspace available for civil aviation. So we were able to bring back capacity in a fast pace.
Corporate?
Corporate is a very good question. It's very different across the globe. So corporate into Abu Dhabi is as strong as before.
Yep.
So all the companies that invest in Abu Dhabi, they're coming back to Abu Dhabi to say, we're with you.
Yep.
We're gonna commit to the future, right? Corporate also outbound Abu Dhabi is really, really strong. So we don't see any difference as of now in terms of new bookings, right? Where we see some difference is in connecting flows for corporate. But that's being overcompensated, and that's related to travel warnings, that they're going down, right? But some corporations, they take longer to remove the warnings, right? But that's being compensated by other flows. For instance, India to the US is booming right now. VFR is booming, right? So we're really happy about that.
What are you having to do on pricing? So in some ways, fuel prices are going up. Like, what kind of a margin squeeze are you feeling if you're selling? Are you compensating for the fuel price rises that you're seeing in terms of what you're seeing in terms of fares?
Not yet. We price to demand and we price to competition, right? So right now, things are back to what we had pre-conflict in terms of new bookings. So average fare is about the same. But if average fare is about the same and jet fuel is 60% more expensive or 70% more expensive, I'm discounting.
Right.
In other words, right? So, but it's okay. It's okay. We see that as a transition phase. Right, we start to see futures in jet fuel go down, right? It's going to take longer. It's not going to be quick, right? But things are coming back on track.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil jumps as Israel strikes what it calls military targets in Iran after intercepting missiles from the Islamic Republic. That is despite President Trump urging Israel not to retaliate. Asian stocks slump as the AI-led rally unwinds and stronger than expected U.S. jobs data reinforces bets for Fed rate hikes. Plus, we discuss the energy crisis with Karen Young from Columbia University and Dubai's property market with OMNIYAT chair Mahdi Amjad later this hour. It's just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. I want to take a quick look at what markets are doing. U.S. futures rebounding from the slump that we saw in the S&P 500 in Friday's close. 2.6% lower for the S&P, 4.8% lower for NASDAQ. That was the deepest. That was the deepest downturn for the NASDAQ since April 2025, and it's really an AI story. The rally that we have been seeing over the past 2 weeks or so started weakening by those Broadcom results showing a weaker than expected outlook for AI. The SOX, which is a gauge for semiconductors, dropped 10%. Now it's gained over 90% this year. So really weighing down when it comes to those valuations, when it comes to the prospects of, has the AI rally gone too fast, too far? We'll answer more of those questions. The contagion has definitely reached to Asia. Asian equities dropping 3% at this point. The Kospi halted trading momentarily this morning before getting back. Nikkei in Japan is also dropping. We have Winnie to talk to us about the details on that. Brent prices is really where the picture is today, almost 4% higher. What we're seeing is $97 on Brent. Fresh round of hostilities between Israel and Iran. Israel hitting cities in Iran. Yesterday, over on Sunday, Hezbollah and Israel exchanged fires as well. So we're seeing that reflected, the geopolitical headlines really reflecting the Brent story. And now the yield on the 10-year notes, 4 basis points as we look at those prospects for a rate hike. But when it comes to Asian equities, let's see what details there are under the hood with Winnie Su in Hong Kong. Winnie?
Morning, Abir. We are seeing Asian stocks falling for a third session on this big tech sell-off that we are seeing globally. And that is really coming as we're seeing all these types of headwinds, including, as you just mentioned, the expectation for the Fed to raise rates, coupled by the rising oil prices due to the geopolitical tensions. But also, interestingly, we are hearing that some investors also trimming their tech exposure for the liquidity ahead of the SpaceX IPO. Now, you can see that the tech-heavy gauges in Japan and Taiwan both down more than 3.5%. But flip the board and take a look at what's really driving declines today. South Korea's Kospi index at one point intraday was down as much as 8% and triggered a trading halt, but now just down about 5% or so. Now, it is a bit of a dip buying specifically from retail investors, and we see a bit of a rebound in SK Hynix and Samsung as well. Now, you can see that South Korea's market has really been a roller coaster, but still, it is so far the best performing stock gauge globally so far this year. And remember, we do still have NVIDIA's Jensen Huang in Seoul, and he unveiled this partnership with SK Hynix and also said that the sell-off in tech is actually a good buying opportunity.
Winnie, thank you for those details. Now, a big story that we've been following over the weekend and some breaking headlines across the Bloomberg terminal. Intesa offers to buy Monte Paschi in a mix of shares and cash. That is coming out now. Some details about this story. Intesa offers 1.6 shares, €1 cash for each Paschi share. Again, more details are emerging as I speak on this evolving story across the Bloomberg terminal. A couple of flashes. It is offering a Paschi 10.091 euros a share and offers Paschi at 30.6 billion euros. A story that has been evolving over the weekend, and more details emerge on that. Now, let's turn back to the oil story, the OPEC story, and the regional story. And that is when it comes to oil prices that are surging after Israel said it struck military targets in Iran following missile attacks by the Islamic Republic, threatening a fragile ceasefire in the region. The latest escalation in renewing concern over energy supplies and the future flows through the Strait of Hormuz. Joining us now to discuss is Karen Young, Senior Research Scholar for the Center on Global Energy Policy at Columbia University. Karen, good to have you on. Good to always speak with you. Let's start with, the latest rounds of escalations between Iran and the United States, but I also want to pin it to the OPEC Plus meeting that happened yesterday. What is your read on that in light of the evolving geopolitical tensions in the region?
Well, thank you, Abir. It's great to be with you. And again, we are entering a new cycle of retaliation between Iran and Israel directly. And this is related to what has been an attempted ceasefire and truce in Lebanon. Iran continuing to really tie its decision-making about negotiations with the United States towards what happens in Lebanon and Israel's continued to attack on Beirut's southern suburbs. So in terms of OPEC and oil markets, we saw basically what everyone expected, a continuation of unwinding of cuts. The problem is there are few producers really able to meet an increase in output. And so what's expected is that these unwindings, these output increases will continue on a monthly basis, perhaps until October. But really nothing new coming out of Kuwait or Iraq. And we have, the very helpful diversions through pipelines in the UAE and Saudi Arabia, but those are at capacity. This was also the meeting, of course, where we had the UAE's exit from OPEC. And so the question mark would be, what increase in capacity could the UAE begin to put to market? And there's really nothing new in that change either. It's in this, as long as the conflict continues, as long as there is tension in the Strait of Hormuz, we're not going to see really an expectation of increase of volume there. What has been more successful, you could argue, from Oman and Russia. And Russia is really important here within the OPEC Plus group because they continue to receive sanction waivers from the United States. And the next one expires June 17th. And I think the expectation is that the U.S. will grant a waiver again. And all this has been, somewhat helpful to markets. You had Anthony on earlier, I think very well explained, this kind of puzzle. We have this, tremendous supply shock, but yet prices are still below $100. And even with this renewed fighting and direct attacks and volleys between Israel and Iran, we've seen an increase really of only about 4%, still below $100 mark. And I think that is, that is surprising, and it's still a bit of a puzzle. Like, why is the market continue to be so sanguine? And it's really a story about the demand destruction, the decrease in demand that's coming from China, and the increase of supply from the Americas. And so we.
So Karen, when it comes to the importance of the OPEC Plus alliance and the meeting that they had this time around, especially that it is the first meeting that they have since the UAE has left, and you talk about demand destruction, you also talk about the geopolitical headlines. Now, from where I'm sitting, the geopolitical headlines that we're seeing coming out from the region are having a way more marked impact than 188,000 barrels increase in quota that OPEC Plus had agreed to yesterday. So my question really is, how important is the OPEC Plus meeting at a time like this where they could supply, but then the argument of getting those oil barrels delivered is still in question?
Yeah, that's right. It in some ways, it's sort of an empty commitment. It is a recognition that they would like to increase production, increase supply to market, but there's simply these just continued constraints, and particularly in the case of Iraq and Kuwait, and even the capacity of the pipeline diversions in the UAE and Saudi Arabia. There's just not much more that can be done. And so I think the question was, what happens when the UAE exits? Are we going to see less of a sort of power of the group of OPEC and OPEC Plus? And maybe that's happening a bit in that, they are cohesive. But even, we heard from the Saudi energy minister just a day ago. He said very clearly, I can't tell you exactly what's going on in markets. Like, this is a bit of a puzzle. So I think there's a bit of modesty and humility about what the group can actually do and how much we can predict where things go next.
So, Karen, in this whole debacle and what we're seeing happening in energy markets and the geopolitical tensions, is Russia ultimately the biggest winner here?
Yeah, I think that's a fair assessment. The other thing we've seen from Russia, and we're going to see this from other producers, is the use of export bans. So Russia began an export ban on jet fuel. Russia is not a huge exporter of jet fuel to begin with, but it just goes to show that we're going to begin to see these policy mechanisms that also are, distortive to the market and are going to hurt, certain importers more than others. And so Russia has had the advantage of these sanctions waivers. They have got a steady demand coming from India, in particular, for their product, and prices are high, right? So that is an absolute advantage to them in this moment.
Karen Young, Senior Research Scholar for the Center on Global Energy Policy at Columbia University. Thank you. Now, Egypt's investment and foreign trade minister says the crisis in the Strait of Hormuz is not heavily disrupting the country's pipeline of investment deals. Mohammed Farid Saleh says the government is actively mitigating the situation by advancing debt swaps with Gulf nations and tendering airport management to boost tourism.
What is happening in the region had its toll, but it is the response that we have done as the government, at the government level, between ensuring that we don't have imbalances re-emerging on the fiscal space, having a proper response on the monetary front. And then when it comes to the investment policy, we made sure at the cabinet level and at the government level is the continuity of operations of companies. That was the crucial point. Companies can be dealing with volatility, can be dealing with the differences and volatility in FX, but they cannot be dealing with operations disruptions.
Now, coming up, the Iran war is beginning to test the resilience of the UAE's property market after years of rapid growth. We'll discuss that with Mahdi Amjad, Group Executive Chairman and founder of OMNIYAT, next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. Now, regional tensions are casting a shadow over the UAE's once booming property market, raising questions about demand, pricing, and investor confidence. Property prices have started to ease, with buyers becoming more selective as the sector confronts its most uncertain backdrop in years. Let's continue the conversation with Mahdi Amjad, OMNIYAT Group Executive Chairman and founder. Mahdi, thank you so much for joining us this morning to talk about a very catchy subject when it comes to the UAE, big contributor to GDP. But what have you been seeing in terms of trends over the past 3 months, especially when it comes to transactions in the industry and in your company?
No doubt, Abir, that the short-term impact that we saw from the conflict created a little bit of a shock in the market. That's back in March and April. But I must say the level of resilience that we witnessed in the market has been really, really strong. Talk about occupancy, hotel occupancy dropped, in our hotels dropped significantly low to low double digits. And we're now seeing recovery up to 85%. Back into 85% category occupancy level. Malls, if you like, retail activities has been significantly higher. And when it comes to property particularly, we saw a very good resilient level of receivable recovery. We don't see any delay in our payments, collection from our customers. You know, we have such an international base of customers. You have to put things in context. The market of real estate more than tripled in the last 4 years, from 300 billion to close to trillion dirham of transactions in 2025. In Q1 2026, we witnessed another record Q1 in the history of real estate market. So we come from a very strong market base.
So since March, since the start of this war, have you seen any marked sense of customers sort of canceling their purchases or asking to cancel their leases, their contracts? And where can you point out to which regions that is happening from?
In terms of the delay in collection or cancellations, we don't see that at all. Actually worked out much better than we expected, I must say. And in terms of the new launches, we have not done a significant launch. Actually, today, in my second brand, Beyond, I'm launching a project despite the current market condition. And as I'm told, the wait list is quite strong. So I truly believe the resilience of market remains strong. UAE has truly demonstrated an unprecedented leadership despite the challenges. This current challenge environment is no doubt is there, and we will live through it like we have done so through a lot of other adversity we have seen and witnessed. But I truly believe the fundamentals of the UAE remain very, very strong. Population growth, the level of leadership. I've been in the country for 34 years. I have seen the population doubled more than 3 times in the last period, in that duration. And the leadership of UAE is very clear in terms of their continuing strategy of driving the growth of population. I always say real estate is a mid-term to long-term asset. So neither you should buy, neither you should sell on short-term sentiments. And always focus on long-term objective of the market.
But then do you see this as an opportunity for dip buying? I mean, we talk about dip buying in stocks quite a bit, but do you see that this kind of provides an opportunity, especially for Chinese buyers, for example, to come into the market and swoop in some deals?
We don't see a big price correction, but definitely market is more quiet in terms of price rise, if you like, compared to historically. So maybe there will be a level of price correction that definitely makes it a great opportunity. Personally, I am looking for transactions to purchase lands in the city further into this year, to build the portfolio further. I truly believe UAE strategy and Dubai, particularly with the growth plans that they have over the next 5 to 10 years in terms of population growth, will continue to drive the pricing in the city. Also keep that in context that Dubai real estate market is still 1/4 of its competitive global markets, capital markets. So we still have a massive growth of capital appreciation in the real estate market.
And speaking of fundamentals, just briefly, do you see supply presenting an issue in the medium term?
No doubt the supply has been significantly strong in the last 3-4 years. And definitely, like every real estate market, supply and demand plays a very critical equilibrium. So I definitely expect a very strong supply in the next 2 to 3 years. And depending on the level of absorption and the migration that we see, that will balance itself out. I always look at real estate mid to long term. I truly believe we will be observing the entire inventory that is coming to the market in the next 3-4 years. And with the level of population growth that we've seen, I think that will continue to be quite a surprising, resilient growth market that we're witnessing.
Mahdi, a pleasure to have you on this morning.
Thank you.
I was Mahdi Amjad, OMNIYAT Group Executive Chairman and Founder. Now, for more of these stories looking into the intersection of wealth and power in the region, sign up for our Mideast Money newsletter on Bloomberg.com. But coming up, Algeria's state-owned Sonatrach has started building a pipeline that will stretch across the Sahara to supply gas from Nigeria to the region to customers in Europe. We'll bring you the details on that story next. This is Bloomberg. Algeria has started building a gas pipeline that will stretch across the Sahara to supply gas from Nigeria and the region to customers in Europe. The 1,210-kilometer section in Algeria is being built by state-owned Sonatrach. Joining us now from Cape Town is Bloomberg's Paul Burkhardt. Paul, thank you for joining us this morning. Can you just give us some details about this project? It really sounds pretty ambitious.
It is quite ambitious, and it's been in the works for a very long time. So even goes back the idea to the 1970s, and then it's picked up since it picked up in the early 2000s, and obviously now with what's happening with gas prices, especially in Europe, it's really starting to gain some momentum. It's the Trans-Saharan pipeline, so it would transport gas from Nigeria through Niger into Algeria and then into a network that reaches Europe. And what we saw last week was the construction starting on the Algerian section, which is like 1,200 kilometers.
And then can you talk to us a little bit about some of the challenges facing this pipeline?
Sure. Well, it's basically comes down to financing and security. So it's probably a fairly outdated estimate of $13 billion for this pipeline, but nonetheless expensive even at that amount. So the states that are involved need to figure out how that's going to be financed. That's been an issue for a lot of these projects that we see where countries are coming together and trying to build something. And the other probably bigger issue is security. And so there's insurgencies, unstable governments in the Sahel, and terrorism for that matter. It's not necessarily it's a pretty foreboding for a pipeline project when you have security issues like that. So that's constantly come up and remains an issue to the project.
Paul, thank you for that. That was Paul Pergart in Cape Town. Now, let's take a quick look at what markets are doing before we head into the end of our show. Equity futures in the United States now pairing some gains, less than a tenth higher. NASDAQ futures rebounding after that slump on Friday, 0.3 higher. Dow Jones and Eurostoxx 50 really hitting hard this morning, 1.3% lower. Oil ticking up because of those hostilities coming back to the region, and then treasuries also not doing much. Now, that's it for Horizons Middle East and Africa. I'm Abir Abu Amr in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.